Hi, my name is Dave Grant. I am the founder of Retirement Matters, and today we're talking about AbbVie's disability policy, whether it's going to be the short-term disability, long-term disability, or AbbVie's buyout program. So let's start off with insurance as a whole. Insurance, you are transferring risk that you hold yourself onto an insurance company and you pay them a premium. In a disability policy, you're essentially paying to insure your income. You're saying to this insurance company, if I'm unable to work, you're going to pay me a benefit until I'm able to work again or until I'm eligible for Social Security, depending on how your policy works. Now, when a lot of people think about disability, they're thinking about quadriplegics. They're thinking about you're in a wheelchair the rest of your life. It's hard to do day-to-day things. That's not the case. When you look at a disability policy, the term disability covers you cannot work. It's very broad. So this could be from anything from being in a car accident and being stuck at home, not being able to get to the office and not being able to work a computer, all the way through to a strenuous game of pickleball and you pulled your back and you're lying up in bed. A disability policy kicks in when you are unable to get to work for 7 consecutive days and a doctor writes you a note stating that you are disabled. Now, in the terms of AbbVie pays for all of your disability coverage. It's the perks of employment, other than the buyout policy, which we'll talk about at the end. And the best way to understand it, let's walk through an example. We're going to walk through an example with employee John Doe. Now, John recently got into a car accident, and he injured his back and his neck. He went to the hospital. He's now back home and recovering, but he's going to need physical therapy for months and possibly surgery down the road to repair some damage. So let's work through his situation and how these benefits come into play and how they may come into play in a situation in your family. So let's say that John was in an accident on the weekend and he couldn't start work at all starting on Monday. John's first going to qualify for 60 hours of hourly sick pay, and it's going to be 100% of his base salary. If John's unable to return to work after this is exhausted, he now qualifies for the short-term disability program. Now let's look at the short-term disability. Short-term disability kicks in when you're unable to get to work for 7 consecutive days following your disability event. Now the first 7 days, the benefits are covered by the sick pay. Now the short-term disability kicks in, and the disability period for short-term disability is 26 weeks. And it's broken up into a couple of different periods. The first 13 weeks, you are paid out 100% of your base pay. The next 13 weeks are 75% of your base pay. Now, let's say that John goes through that whole 26-week period. He is still classified as disabled. He cannot get to work and do his job. Now he's going to move into the long-term disability program. Starting in that 27th week after the short-term disability finishes, he's going to receive 60% of his base pay for the next 24 months. There's a caveat there. We'll go into that in further detail in a little bit because what happens after 24 months depends on your age. Now, the nice thing about moving into the long-term disability program is the terms change. So when you're looking at 60% of salary, when it's looking at salary, it's now including all bonuses and all plans that John Doe would be part of. It's not just the base pay. So potentially what is included in that 60% has now gone up substantially. Now, once you get to that end of the 24 months, if John still can't go to work, and let's say he's disabled for the rest of his life, he is going to get paid out benefits until he turns 65 and is eligible for Medicare. Now, statistically, you are going to be able to go back to work. So let's say that John goes back to work. He comes off the disability plan. He goes back to work earning what he was earning before, or whatever the situation might be. If he re-injures himself around that same disability, he's going to go back into the disability program where he left off. So let's say he was 12 months into that long-term disability. He's now back going into month 13. If it's a new disability, or he's gone a long period of time before he then re-injures himself, he's going to go all the way back to the start, and he's going to use his sick pay, short-term, long-term disability programs. Now, you do need to note one thing. All of these benefits are offered by AbbVie and are given to you at no cost. That affects taxes. So let's say that you become disabled. Let's say that you're receiving $5,000 a month in benefits. that $5,000 a month is taxable. So it's coming to you as though it was earned as income because you haven't paid for it in terms of a premium. So that means on your tax return, you're going to be filing $60,000 of disability income, 5 times 12 months. It's going to be taxable. You're going to need to use the rest of it to provide your care and what other income you may have as a family. If you are paying premiums for the long-term disability, that means that that benefit comes to you tax-free and you don't have to pay taxes on it. So you do need to understand that distinction if you're getting it as a benefit from the company versus if you're paying for it by yourself. Now, the reason I talk about the taxability of it is we're going to look at AbbVie's supplemental plan, which is the buy-up long-term disability policy. You're paying for that. So that benefit's going to come to you tax-free versus the group plan, which is going to come to you and it's going to be taxable. So what is the buy-up plan? So with the group benefit, that's going to be 60% of your salary. If you choose to buy more benefits, you may purchase an additional 15% to bump that benefit up to 75% of your salary, and it essentially increases the benefits that you're eligible for and you receive each month. Now, there's a couple of good perks on this one. What can happen is you can purchase this benefit. The benefit can go up to $15,000 a month. So you could be receiving a substantial portion of benefits when it comes to long-term disability that may take care of all of your care or even more of your care, depending on what type of disability you have. The nice thing with the supplemental plan, because you're buying it yourself, you are actually able to port that plan. Remember when we did the life insurance, you can port life insurance when you leave the company. So should you leave AbbVie, you can take this supplemental plan with you and you don't have to go through medical underwriting for a new policy or policy based on your age again. You can start to move this with you as you go into different situations. So as I'm working with clients as we go through their plan, when we're talking about disability, not much happens when we're talking about the short and the long-term disability. That's given to you as a company. The conversation we do have is based around the buy-up plan. Depending on how much expenses you have in your family or what you can afford in terms of buying a long-term buy-up plan, that's going to determine what you do in terms of buying it some more, and it's going to determine how your plan shapes out. If you have any questions, please feel free to reach out to me at Retirement Matters. I'll see you on the next video. Take care.